from rupee to dollar. Who really drives the movement of a currency? It's exactly midnight. Across different time zones of the world, screens are glowing. London, New York, Tokyo, Mumbai. Thousands of traders have their eyes fixed on one thing, the exchange rate. A small breaking news flashes, and within minutes the dollar strengthens, the rupee slips, the yen jumps. No parliament has passed a decision, no president has made a statement. Yet the pockets of millions are affected. The question is, who is this invisible force that decides how many rupees you get for $1? Is it an order from a central bank or some unseen wave of the market? The fear is that if you don't understand this game, your savings, investments, even your EMI can shake. And the curiosity is, who is the real player in this game? Every day we hear that the rupee strengthened against the dollar or fell to its lowest level. But an exchange rate is not a fixed price tag that one person or institution sets every morning. Most countries in the world follow a floating exchange rate system. That means the value of a currency is decided by demand and supply, just like in a vegetable market. If the demand for tomatoes rises, the price goes up. In the same way, if demand for the rupee rises in the international market, the rupee strengthens. Now the question is, how does this demand and supply actually form? Suppose countries around the world are buying more goods from India. To make payment, they will need rupees. They will sell their dollars and buy rupees. This increases demand for the rupee, and its value strengthens. On the other hand, if India is importing more goods, especially essentials like oil, India will need dollars. In that case, rupees will be sold to buy dollars and the rupee may weaken. But the story isn't that simple. The currency market, called the foreign exchange market or Forex market, is the largest financial market in the world. According to data from the Bank for International Settlements, more than $7 trillion worth of Forex trading happens every single day. This market operates 24 hours a day. Banks, hedge funds, corporates, governments, and individual traders all participate here. So this is not just about export and import. It's also about speculation, hedging, and investment. Now let's come to the role of the central bank. In India, it's the RBI. In the United States, the Federal Reserve. In Europe, the European Central Bank. These institutions keep an eye on the stability of their currency. Even though exchange rates are decided by market forces, a central bank can intervene when needed. If the rupee starts falling too fast, the RBI can sell dollars from its Forex reserves. This increases the supply of dollars in the market and can help stabilize the rupee. Similarly, if the rupee becomes too strong, exports may suffer and the RBI may buy dollars to balance the situation. Around 2024, India had more than $600 billion in Forex reserves. These reserves are important because they allow the RBI to intervene in the market when necessary. But intervention also has limits. The RBI does not fully control the exchange rate. It mainly tries to smooth volatility. This is called a managed float system. Interest rates also influence the value of a currency. If the RBI increases the repo rate, investing in India may become more attractive. Foreign investors may bring in dollars to invest in Indian bonds or equities. This increases demand for the rupee. Similarly, if the Federal Reserve raises interest rates in the US, capital may flow back to America. That can strengthen the dollar and weaken emerging market currencies. Now let's talk about reserve currency status. The dollar is considered the world's reserve currency. According to IMF data, around 60% of global foreign exchange reserves are held in dollars. Oil trade, often referred to as the petrodollar system, is largely settled in dollars. That means countries importing energy need dollars. This keeps dollar demand stable. That's why even during global crises, investors rush toward the dollar. It is considered a safe haven currency. But the world is changing. The euro, yuan, and yen also have a share in global trade. China has been trying to internationalize the yuan. BRICS countries have discussed local currency trade. But the depth and liquidity of the dollar remain unmatched. The US bond market is the largest and most liquid in the world. Investors get a combination of safety and return there. That is the strength of the dollar. Another important factor is inflation. If inflation in a country is high, the purchasing power of its currency declines. Investors may move away from that currency. Over the long term, high inflation leads to currency depreciation. That's why central banks focus so much on controlling inflation. Stable inflation, strong GDP growth, and political stability. These are the three pillars of currency confidence. Political risk can also shake a currency. If there is sudden election uncertainty, war, or a policy shock in a country, investors may pull out capital. Capital outflow puts pressure on the currency. The Asian financial crisis of 1997 is an example, where a crisis starting with Thailand's baht dragged down several Asian currencies. The 2008 global financial crisis and the 2013 taper tantrum also showed how global liquidity and sentiment can rapidly change currency markets. Foreign direct investment and foreign portfolio investment also create demand for a currency. When a multinational company sets up a factory in India, it brings in dollars and converts them into rupees. This can strengthen the rupee. But portfolio investment is more volatile. If global risk appetite declines, FPIs can exit quickly, putting pressure on the currency. Trade deficit is also important. If a country imports more and exports less, it needs more foreign currency. That can weaken its own currency. India is an oil importing country. When crude oil prices rise, India needs more dollars. This can widen the current account deficit and put pressure on the rupee. Speculators and traders can influence currencies in the short term. If the market believes that a country's economy is weakening, traders may sell that currency. It can become like a self-fulfilling prophecy. That's why central banks focus on communication strategy. Forward guidance and policy statements help shape market expectations. Some countries follow a fixed exchange rate system. For example, certain Gulf countries peg their currency to the dollar. That means their currency is tied to the dollar at a fixed rate. This provides stability but limits monetary policy independence. A floating system offers flexibility, but it can also bring volatility. So, does any single person decide the exchange rate? The answer is no. It is the collective result of millions of transactions, decisions, and expectations. Market psychology, global politics, economic data releases, all combine to determine the rate. Every time US jobs data is released or India's inflation data is announced, the Forex market reacts. The value of a currency is not just about economics. It is also about trust. If the world trusts that a country's economy is strong, its debt is manageable, and its institutions are stable, then there will be confidence in its currency. That's why during crises, currencies like the dollar and Swiss franc see increased demand. For an emerging economy like India, maintaining balance is a challenge. It needs growth, export competitiveness, inflation control, and currency stability, all at the same time. The RBI often walks a tightrope, adjusting interest rates, intervening in forex markets, and guiding expectations through policy communication. The fear is not that the rupee will move up or down. Exchange rate movements are normal. The real fear arises when movements are uncontrolled and sudden. That's why central banks try to smooth volatility. But the long-term trend is determined by market fundamentals. In the end, let's return to that midnight screen where exchange rates were flashing. There isn't one single controller sitting there. It's the collective mind of the world at work. The value of a currency is a reflection of economic health, political stability, global trade dynamics, and investor sentiment. It's the modern version of the invisible hand. The next time you hear that the rupee strengthened or weakened against the dollar, understand that behind it are millions of transactions, decisions, and global forces. A currency's movement is not built in a single day. It is shaped by trust, balance, and the power of markets. And that is the biggest truth of this game. The exchange rate is not one person's story. It is the story of the entire world.
If our video has taught you something new, do not forget to like and share this video so that this information can reach others as well. Your likes and shares are a source of inspiration for us. If you have any questions or suggestions, please let us know in the comments. It will be our honor to answer your questions and listen to suggestions. And yes, if you like our content, subscribe to the channel and press the bell icon so that you stay connected with every new story. Thank you. GRT Business YouTube channel sources, news from various news agencies, opinion polls and other public sources. We try to ensure that every report and summary is accurate and verified, but we are not responsible for any dispute or error. Our aim is only to provide you with accurate information.